On behalf of Crosscheck Media and Biz Talk Today TV, welcome everyone to The Money Path. I am your host, Todd Schoenberger, and joining me today is Sam Stovall on this very short trading week for Christmas. And Sam, happy holidays to you and yours, and thank you for joining me today. I want to ask you, though, when you have the S&P 500 up 17% year to date, if I'm new right now to the game of Wall Street and investing, and I went to you, would you tell me to sit back and not get into the markets now, or should I jump right in?
Now, first off, happy holidays, Todd. I guess I would tell an investor, look, why are you investing first off? And the answer probably should be for the long term. And with that in mind, I would say you're better off putting the money to work today because who really knows what is likely to happen? I mean, we make our best guesses for the coming year, usually in December or even November of the previous year. And more times than not, they come close. I like to say that target prices are more of a weather vane than a laser beam because it sort of gives an idea of the overall direction, but rather than trying to come up with an exact ending value, I think is also a bit to do with luck. So I would say, you want to invest for today, and then the question is, what kind of a strategy would you embrace?
Yeah, that's some great advice right there. Well, Sam, you are the chief investment strategist at CFRA Research. So I have to ask you, I saw your sector watch was released today, this morning, and it's really giving us a little bit of an idea, forward-looking outlook for 2026. We can start with the Santa Claus Rally. For those in the audience that aren't familiar with our mutual friend Jeff Hirsch and the Stock Traders Almanac, can you just give a little bit of an education for the audience about the Santa Claus Rally?
Sure. Well, I've learned a lot from the Stock Traders Almanac, and the Santa Claus Rally basically gives an idea as to what might happen in the year ahead. It looks at the trading action in the final 5 trading days of the prior calendar year, plus the first 2 days of the new calendar year. And what's interesting is that it has actually given a pretty good indication of what's likely to happen in the coming year. Since World War II, the S&P 500 has risen an average of 9.3% and gained in price 72% of those calendar years. The numbers obviously are better if you add dividends. The Santa Claus Rally, meaning if we have a positive movement in those 7 trading days, instead of 9.3%, it indicated that the market was up an average of 10.4%. And instead of rising 72% of the time, it was higher 74% of the time. So, just a slight improvement, sort of giving an idea that investors are still fairly optimistic about what the likelihood of an advance would be in the coming year. If the market was down in that Santa Claus rally period, then you had the market up an average of 6.2%, rising only 65% of the time. So it's a slight upward, downward direction, if you will, for the outlook for the overall market.
So overall, you seem very optimistic on the markets. It's safe to say, and nobody knows what's going to happen during the Santa Claus during those trading days, but there's the outlook is positive. Wouldn't you agree?
Yes, I would. My outlook for 2026 is I don't think we're going to get a four-peat, meaning that 4 successive years of double-digit gains. That has only happened 2 times since World War II. I think that it probably could be a positive year in that I call myself a bull, but with a lowercase b. The average gain in midterm election years is less than 4%, and the market has gained really more like a coin toss, up only 55% of the time. So a lot of volatility, I think, is likely to be seen ahead. But because earnings growth expectations are expected to be about 14% for 2026, and now the estimates for 27 continue to rise and are approaching 15%, that rise in earnings expectations will likely go a long way to sort of neutralizing the fear that investors have regarding valuations at this point.
So, Sam, what do you think now for Wall Street traders? The second half of the year of this year we saw a real push, an optimism from Fed action, from easing, and therefore that was helping to propel the markets. But we've also received the fortunate quarter period where earnings have actually outperformed. Do you think Wall Street is now going to shift more back to the earnings side, or do you think there's concentrating way too much on the Fed?
Well, I think they got what they wanted in their stockings from the Fed, that being, the second year of a rate easing program. Historically, the market has done very well following, that kind of a program. The market was up an average of about 11.5% during second year easing cycles since 1990. All
Wow.
sizes, all styles, all sectors, and 90% of the 85 or so sub-industries that extend back to 1990 in the S&P were up in that second year. But you're absolutely right that, okay, how much more can they do? Well, a little bit, maybe one or two times additionally in 2026 is what the market is looking for. But the focus, I think, will be on earnings. And as I had mentioned, expectations are for a little more than 14% in 2026, 15% in 27, and all sectors are expected to post increases with three of them likely to see double-digit gains in 2026, led, not surprisingly, by technology with a 30% advance.
Wow, that's crazy. That's amazing. I know there are a lot of happy investors then. So I've taken a look at your sector watch today. Very thorough. I highly recommend the audience take a look at it as well. You do mention about last week's economic data. We got a tsunami of economic data. This week is the preview of GDP. So, and your estimates actually are lower than what we've seen this year. With that though, the with the economic data, has that shifted your outlook for 2026 at all? I want to break it down on a sector by sector level though. I know you're optimistic on tech. You also mentioned consumer discretionary, but are there other sectors that are standouts for you?
Well, first off, in terms of the macro look, our expectation is that GDP should rise by 2.5% in 2026 versus the 2% expected for all of 2025.
Hmm.
Our feeling is that what's the old saying? Consumers stop spending only when the banks stop lending. And so we actually see Q4 retail sales at 3.7% next year versus 2.2%
Oh,
for
okay.
this year. We do see inflation going down, hitting about 2.4% on year core PCE by the end of next year. The 10-year note, we think, will breach below that 4% threshold, which should be a positive overall. And we think that oil prices will remain below $65 per barrel. So that should be beneficial. In terms of what could happen with sectors and so forth, uh, you were sort of asking the beginning question of, here it is, the end of one calendar year, and as we move into the next calendar year, should I buy last year's winners or last year's losers?
Yeah.
Well, the right answer to that and most financial questions is that depends.
Right.
If last year was a down year, you want to buy last year's losers. If last year was an up year, you want to let your winners ride. Since 1990, by taking this alternate approach, in terms of buying either the top three or bottom three sectors. It gained 13.2% on average versus 10.5 for the S&P 500. And those three sectors beat the market a shade more than 70% of the time. On a sub-industry level basis, you want to look at the top or bottom 10 sub-industries, and by embracing that rotational approach, you would have seen an average 17.8% rise,
Wow.
also beating the market about 70% of the time. And if the year ended last Friday, December 19th, the three sectors were communication services, industrials, and tech. And if you're looking at the 10 sub-industries, they were construction machinery, electronic components, electronic manufacturing services, gold, healthcare distributors, healthcare facilities, heavy electrical equipment, interactive media and services, leisure products, and then finally semiconductor materials. So a pretty good distribution between technology, healthcare, some industrial, some materials, but in general, basically expecting the economy to hold up well, no recession in sight, and that while we could end up seeing increased volatility because midterm election years by far have the greatest amount of volatility with an average drawdown of 18% since World War II. But
Hmm.
as we saw in 2025, where we experienced a 19% decline, we got back to break even in about 2.5 months and are still up by more than 16% on a year-to-date
Wow.
basis.
That's incredible. Definitely a broadening of leadership as it seems. So on the sub industries, when you're speaking of semiconductor and electronics, is that also are you thinking AI infrastructure within those groups?
Well, when you look at semiconductors by themselves, I picked the largest company within the sector that has the highest CFRA stars ranking, and
Mm,
that's a
okay.
stock appreciation ranking system. So, semiconductors just fell out of the top 10 list, but NVIDIA is our favorite in that category. Lam Research is still in the list. So that one is a four-star recommendation within semiconductor materials. Also, you have companies like GE Vernova that's going to be powering a lot of these data centers, electronic manufacturing services like TE Connectivity, electronic components like Amphenol. So, you still have companies that are tied to technology and AI, but it's not exclusively an AI list.
I want to ask you on the macro side. You mentioned that you have a GDP forecast of 2.5% for next year, which is very healthy for the U.S. economy. As you know, historically speaking, you need the GDP to go up 2 to 2.5% to maintain a level rate of employment as the population grows. This year is we are expecting a population decline. It'll be the first time in U.S. history. And with immigration enforcement also taking place, do you feel that 2.5% though should be re-examined where it might be a little too hot for the Fed?
Well, it's certainly a possibility because I think at the beginning of 2025, our expectation was slightly higher than 2%. And we really had not been anticipating such a broad swath of tariffs being put into place. So obviously, we continue to adjust our GDP forecast. I think the focus really is to say that we are not anticipating a sharp slowdown in economic growth or even a recession. You know as well as I do that bull markets don't die of old age, they die of fright. And what they're most afraid of is recession. And actually, the average bear market during a recession has seen a decline of 35%. So that's something we would rather avoid at this point. And I think earlier in 2025, worries were that the tariffs would throw the U.S. and maybe the rest of the world into a global recession, but that was quickly resolved, and we experienced that 19% correction in under 2 months. Normally, corrections take 4 months to go from peak to trough, and then 4 months to get back to break even. But we went from peak to trough in only 2 months and then back to break even in about 2.5 months. So swift tends to imply shallow and also indicates that the next decline would be relatively minor, which we got down only 5.1%. So history now implies, but obviously does not guarantee, that we could probably advance another 8% over a 3-month period before sliding into another decline of 5% or more.
Wow, it's very impressive. No, you were very optimistic. You're looking at a 2.5% GDP, 2.4% on inflation, no recession. I mean, everything looks great. Then why wouldn't you have a double-digit outlook for, say, the S&P?
Well, I think because my outlook is 7,400 for the S&P 500,
Okay.
which is a high single digit if we do close around 7,000, which I anticipate. Some concerns are that we were recently trading two standard deviations above the mean in terms of the average forward PE ratio for the S&P 500. Believe it or not, at the end of October, tech was trading at a 72% premium to its 20-year average PE. But the real question comes down to, is a 20-year look back appropriate? Because our technology sector group head, Angelo Zeno, is of the opinion we should be looking at 10 years or maybe even 5 years, because that's how far back AI really has been driving the sector and the market. Most recently, we had technology come in at a 39% premium over its 20-year PE, but only a 1% premium over its 5-year PE ratio. So the most recent digestion of gains for technology, in a sense, could be all we're going to experience, at least for the near term. But I think the reason that I'm not uberly optimistic is because, historically, very, very few of those years have actually had 4 successive years of double-digit gains. Average gain for midterm election years, 3.8%. Frequency of advance at 55%. Also, we have a wave in Washington, meaning the president and both houses of Congress are the same party. Whenever that happens, you have an increase in midterm election year volatility because we've seen an average of 4 seats in the Senate change hands and 36 seats in the House change hands. So that could result in a unified Congress opposing the sitting president.
Right, right. And that is the thing. We have a big midterm election season coming up. And I want to address that too, because it's not just the election season, it's a Supreme Court ruling on tariffs. Now, I know you at CFRA, you guys will adjust your numbers, but what is CFRA thinking if the Supremes actually say, yeah, these tariffs were illegal and now we have to start rebating countries?
Well, I think that they might be saying that it might be illegal, or he didn't have control over or justification to refer to them as tariffs. So the administration has already said that they would simply call it something else in order to allow it to be maintained. So it's one of those situations that, in a sense, if the Supreme Court zigs, then the administration is going to zag. And
Right.
as a result, we're probably not going to be seeing the administration repay the companies for the tariff duties that they had to incur. So that's an additional level of uncertainty. And that's why I believe that with these headwinds could hold back investor enthusiasm. However, I do remind you of a historical situation that is a bit uplifting, and that is essentially once the midterm elections have run their course, the uncertainty has been lifted. From October 31 of midterm election years since World War II through October 31 of the year after, the market has never declined, and the average gain was 16%. So we could end up seeing a nice double-digit gain starting in the end of October of this year and into end of October of next year. But I think that because of all of the uncertainties, yeah, we'll still have an up year, but I don't think it'll be double digits.
That's amazing. And does it matter on which political party is in power?
Not really.
Okay.
Basically, just the market is happy that the uncertainty has been
Mm,
lifted.
that makes a lot of sense then. Absolutely. So, Sam, I want to ask you the one question though. I know what your outlook is for the S&P for next year. Do you have a favorite sector? Is CFRA speaking internally? I mean, I'm sure tech is probably up there, but is there something else that hasn't been reported?
Well, we have overweight recommendations on communication services, financials, and technology, and a preference, if you will, for the industrials area. Utilities had been in the top three until recently, so that could be an area that will continue to do well if the AI picture remains fairly solid. We have been seeing a digestion of recent AI-generated gains in both tech and utilities. So, should the picture remain optimistic, they could actually do well again as we move forward. And if the market is continuing to do well for the full calendar year, while we might have some short-term rotation into the more defensive areas such as consumer staples, we are seeing an improvement in healthcare. So we have both staples and healthcare ranked market weight at this point, because our belief is that while we're not ready to say overweight on those groups, they will probably represent some good safe havens during more challenging times in 2026.
Interesting. So in your list of overweight and market weight, I can't help but notice you didn't mention real estate. Is that an underweight sector?
We do, yes. Underweight is real estate. Materials at this point is underweight. You might
Hmm.
think, well, gee, why wouldn't it be overweight with gold and silver doing so well?
Right.
Mainly because it is dominated by the specialty as well as the diversified chemicals companies, as well as some of the non-ferrous metals, non-precious metals, and such. So there are a lot of diverse groups within the material sector. So right now, we have underweights on real estate and materials, but we are constantly keeping our pulse on the sectors, looking at the recommendations by the analysts, but also then overlaying seasonality, cycles, and technical considerations.
So, and then final question then, because you brought up gold, and what are your thoughts on gold and silver at this point? We've seen such a big run up, especially in silver. Do you believe it may continue and why?
Well, yes, it may continue. I think you have a lot of central banks that are sort of protecting themselves at this point by
Hmm.
buying into the precious metal. The value of the U.S. dollar has been easing because interest rates here have been coming down, and since gold is priced in dollars, that has been a benefit to that commodity. Silver tends to be the poor man's gold, and that has done very well as gold has eclipsed the 4,000 threshold. So we're still optimistic on gold, think it could be reaching between 4,500 and 5,000 over the coming 12 plus month period.
Wow.
So we have buy recommendations on Newmont Mining as well as Royal Gold.
Wow, that is impressive. Well, I know we're going to be talking again about this, Sam, because you always bring the A game when you come to our show. So I really want to thank you for joining me today. But I would really want to wish you and the team at CFRA and your families a wonderful holiday season and a very happy new year. And I can't wait to talk to you again next year.
Same here. Thanks a lot, Todd.
Thank you, Sam. So, on behalf of Sam Stovall, I am Todd Schoenberger. Thank you for joining us on the Money Path. Coming up at 2 o'clock on the Money Path today, Jessica Andrews. She is the general manager of family offices and multifamily offices at Bright & Jones, and we're going to break down the family office space for you. So, until then, take care.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.